Good morning, everyone, and welcome back to Morning Markets. A number of things as a team we've been discussing this morning that I'd like to share with you. The first of which is our normal review of asset markets and what's been happening over the past 24 hours. I think what we can observe there is continued performance from equity markets, with most major global equity indices yesterday closing up over 1%. And again, in a similar vein to earlier in the week, we saw some of the more economically sensitive sectors in the US in particular performing strongly yesterday, with transportation and banks performing ahead of the broader market. So again, that is one of these data points that we've been highlighting, and something that we continue to watch to see if there is any sense that the equity market is becoming slightly more broad and we're seeing a recovery in some of those more economically sensitive sectors. The other interesting fact that we were just looking at this morning is the continued performance of oil and oil prices recovering. If you remember back to this time last month, we were approaching sort of a very volatile period for oil markets, and in particular in the US, where we saw oil prices trade negatively as we faced into the futures rule and what that meant given the lack of storage capacity in the US. We got some data last night that allowed us to think slightly differently about the futures role in the coming days. Why is that? Because it does look as if storage capacity, or the utilisation of storage capacity at Cushing, has declined. So 5.6 million barrels left the facility, so providing more storage for those that want to take physical delivery as the futures roll this month. So that may mitigate some of the volatility in the WTI market that we saw last month. I think the other thing that we touched on this morning is the sovereign markets and what we saw there yesterday. A very interesting development in the UK gilt market yesterday, where the Debt Management Office, the DMO, sold £3.75 billion worth of debt with a 3-year term. Not massively interesting in and of itself, but it was the first time that they've sold gilts at a negative yield of 0.003%. That's quite a historic moment. That's something that we haven't seen before. The last time that the debt was sold with a negative yield, it was a short 1-month bill in 2016. So for a fixed coupon bond, that is a significant change. It's also a positive in the sense that it does suggest that the fiscal support programme that the government have put in place can be funded and will be funded, with market participants willing to potentially fund at a negative rate. That does, however, have other implications, and what did we see yesterday was that sterling weakened against the dollar. We saw sterling come off about 0.5%. Why is that? Well, one is around the debt issuance, but then secondly, comments from Andrew Bailey when he was testifying in front of the Treasury Select Committee just highlighted how the Bank of England policy towards negative interest rates continues to evolve, and certainly not ruling it out. And that's in probably contrast to what we saw and read from the Federal Reserve in the US in their minutes from their April meeting, where there's very little reference to negative interest rates. I think it looks as if it's been discussed, but nothing really concrete put down on in the minutes. That in and of itself, I think, is interesting. The Fed continue to believe that they can use the conventional, I suppose, in inverted commas, policies that they are using today to continue to support from a monetary basis the US economy. A couple of other things in the minutes that I found interesting. One, they highlighted the fragility that there is in emerging economies, and that's something that we have been discussing with our managers over the past number of weeks, and particularly how that relates to emerging market debt and the exposure that they have there. I think the other thing in the minutes that is worth noting is the Fed thinking about how they can provide forward guidance and what sort of guidance they need to give market participants, but also the US public about the direction of interest rates and monetary policy over the medium to longer term, specifically thinking about what data they can use to potentially help in that decision and tie it to that, and looking at what it means for unemployment and inflation. Can they use those as indicators to the public and to market participants? The other thing this morning is just a continued build on something that we discussed yesterday, and that growing rhetoric that continues to grow and crescendo between the US and China. Overnight, we saw the Senate pass a bill that will make it more difficult for Chinese companies to list in the US, and that follows on what we discussed yesterday from NASDAQ. And then also we've seen, I suppose, an escalation in the use of Twitter by President Trump, and just this war of words with China and the leadership of China. So that will, I suppose, continue to play on markets' minds. What does this mean? How should we think about this from a trade perspective? Does this add to the concerns that we've got about economic recovery as we try to reopen economies post COVID-19? Turning then to today, we've got a number of purchasing manager indices from Europe and the UK, which I'll come back to and discuss tomorrow. And then we have the US unemployment, the weekly unemployment data this afternoon. That's it from today. I hope you found that useful. I'll join you again tomorrow. Thank you.